Welcome to another PTG presentation. Today, I'll be talking about the SPDR S&P 500 ETF, better known as the SPY ETF. I'll be talking about what the risk and rewards are, an example investment, and where to go to get more info should you choose to buy it. So before we get started, be sure to subscribe to our channel so you can be notified of new content when it releases, and hit that like button so we can continue to bring you great content. Investing in the SPY ETF. What is the SPY? A fund that tracks the stocks of 500 large U.S. companies from different sectors in the S&P 500 and averages them for diversification. So below, I've listed just a few of the big names that make up the SPY, such as 3M, Starbucks, IBM, Apple, McDonald's, Procter & Gamble, GM, FedEx, and more. It's a global broad-based ETF that has the largest trading volume with average daily dollar transactions of $21 billion a day. SPY is a basic vanilla fund designed for passive, longer-term investors and can be bought like a stock from your broker. It's currently valued at $342 a share. The fund is market cap weighted, which means larger companies account for a greater portion of the fund than smaller stocks. This means the movement is levered to a small set of stocks. So let's look at the top 10. It's these companies that make up almost a third of the SPY. Note also that the ETF is tech heavy, with Facebook, Apple, Microsoft, and Alphabet making up about 20% of the fund. These are the stocks that drive the movement of SPY, and so it's their performance and results that are key. Now, looking at the sectors that make up the SPY, the tech sector as a whole makes up 35% of the fund. And if you were to take the four sectors of technology, consumer cyclicals, healthcare, and financials, you'll see that those sectors make up 75% of the SPY. And so it's worth being aware of the news flow in those sectors. So if we look at the four sectors of technology, consumer cyclicals, healthcare, and financials, they make up 75% of the SPY. And so developments in those sectors are worth being aware of in terms of news flow. With the SPY ETF, there are some terms you should be familiar with. Liquidity means that there are enough buyers and sellers to provide high enough trading volume for you to transact at fair prices and allow for your orders to get filled efficiently. With an average daily volume in the billions, SPY liquidity is high and reliable. The expense ratio is the fee the fund charges a client for investing in the fund. It's an annual charge the fund makes to cover their operational costs, and the fee is a small set percentage charged to your total SPY investment. The one-year total return is simply the annual return on investment. To calculate your return, simply multiply the original investment by this percentage. And dividend investors will be glad to know that SPY pays an annual dividend. This is a yearly payout the fund pays the investor for each share of SPY held. The dividend yield is a small set percentage as well. So now that we know a few things about the SPY, let's look at the benefits and risks of investing in it. SPY is the world's largest ETF with over 300 billion AUM. So that makes it liquid, tradable, and reliable. It's diversified, so risk is spread out across 500 different stocks. This protects from adverse effects or results like those present in single stock investments. It also eliminates the burden of selecting individual stocks and the amount of time and research that goes into managing them. So since SPY is a long-term passive investment, it requires less effort to follow the broader market than it does for single stock investments. The fees to invest in SPY are reasonable. For example, the cost to put on a $10,000 position is only $9.45. Is it for you? Well, that's something only you can decide based on your own risk profile and return goals. SPY can be a passive investment to balance alpha in a portfolio. Conservative dividend investors prefer its safe and steady returns. And being risk adverse, these longer-term investors seek diversification and broad market exposure as opposed to single stock risk and volatility. SPY can be a passive investment to balance alpha in a portfolio. Conservative dividend investors prefer its safe and steady returns, and being risk adverse, these longer term investors seek diversification and broad market exposure as opposed to single stock risk and volatility. In simpler terms, SPY can be an ideal product for those who don't want to endure the ups and downs of stocks that results from quarterly results and all the emotions that follow before and after. The risks. Since SPY is a broad market ETF, it is exposed to global news flow, economic releases, and geopolitical headlines that move the general direction of the S&P 500. So be aware that it's still subject to market fluctuation, although it may not be as dramatic as the ones that you will see if you were to be invested in the actual individual name. Let's move on to the rewards. So we're looking at a 10-year chart of the SPY. And if you look to the left of the chart, a 10K investment made in SPY in December of 2010 would have netted a $10,000 return in December of 2015. This would have resulted in a 100% return. Now that same investment held another 5 years to present, had a value of $40,000 in September of 2020, which would have been a 300% return on investment, which is not bad at all for an investment that was held for 10 years. Not every 10-year period will be a bull market, but this chart is a good example of the long-term rewards of SPY. So now let's look at how to calculate a hypothetical $50,000 investment in the SPY ETF. So what we're looking at here is the prospectus from State Street, and it's just a portion of the prospectus, and the metrics that we want to look at are the last three, which are the dividend yield, the annual return, and the expense ratio. And we want to calculate what the investor cost is, the return on investment, as well as what the dividend payout is. So in order to calculate the investor cost, take that $50,000 investment and multiply it by 0.0009, the expense ratio, and your annual total fee to put on this trade is $45. To calculate the return on investment, multiply $50,000 by 0.1876, which is the annual return percentage for 2020. And the return on investment would then be $9,380. To calculate the dividend yield, which is paid out yearly, take the $50,000 investment, multiply it by 0.0169, which is a dividend yield, and your annual payout would have been $845. We know what SPY is. You understand the benefits and risks of it. And having looked at an example investment, let's finally look at some places where SPY is available. So the SPY is tradable through most online brokers. And if you're unsure, go ahead and check your ticker symbol SPY to see if it's available through a broker. The ones I've listed here are the largest and most reputable funds, with State Street being the originator of the SPY ETF product, Interactive Brokers being one of the largest online brokers, and Vanguard being very well known for their ETF products, and BlackRock, which is one of the largest asset management firms out there. The main thing to look at here is fund reliability when choosing a place to open an account. And fund reliability just looks at the amount of time, the history that the company has, possibly the assets under management that they have, and just the size of the company itself. So when looking to open an account, if you don't already have a place to purchase SPY, you'll want to look at fund reliability, which is just the history of the company and the reputation. It's always good to look at fund reliability. And when you look at this, you want to see the amount of years that the firm has been in business, and also the sheer size of the company and the amount of transactions that they do for the financial product. To recap, SPY is highly liquid, making it reliable to invest in. It has a history of steady annual gains long-term, and that makes it ideal for mid to long-term investors. Be sure to look for low expense ratios and fund reliability. SPY is diversified, so avoids exposure to any one stock, and this evens out your risk. The SPY ETF can be a conservative addition to your portfolio. Remember, investing does not have to be complicated. Long-term, leaving capital in a broad market index fund like SPY can be profitable. Investing in SPY is much like taking a train to get from point A to point B. It may not be the fastest or sexiest way to get to your investment destination, but it is safe, reliable, and just as efficient. I hope you found this video on the SPY ETF useful. Be sure to like the video below, subscribe to our channel, and have an amazing day.